Tax, tax, tax. And how do we save ourselves from paying too much tax? So that is the question in everyone's mind. Last week, we spoke about asset protection when structuring a person's estate, when structuring their investment portfolio, or when structuring their property portfolio. This video is about tax. The first thing that I need to mention though, before we start off, is that you should never structure your estate purely on tax. Remember, you have to consider asset protection, you have to consider finance optimization. You cannot be totally reliant on tax, because the trap that most people fall into is because the tax legislation is incredibly dynamic and consistently changing. If a person structures their estate too rigidly, relying only on tax, if the tax legislation ever changes for some reason or another, they're stuck. It's a rigid approach. And how we normally approach it in practice is we try to structure the estate in such a way where the most basic tax principles apply, so that a person can take some solace or some ease in knowing that these principles have been around for many years and are unlikely to change. Now, structuring a person's affairs in order to have the most convenient tax structuring, there's absolutely nothing wrong with that. That is an acceptable practice. It is not tax evasion. It's simply making sure that your affairs are structured correctly and legitimately, but in the most tax efficient way. And that is entirely allowable. So there's two different approaches that we need to take when trying to get to final solutions, right? Now, the first one is one needs to distinguish between short-term efficiency and long-term efficiency. So what tax am I paying today versus what tax am I going to pay in several years? The second thing is that we need to understand our different tax types. What taxes do we usually pay under these circumstances? Now, there are quite a few, and I'm going to run through the basic ones just to give you an understanding of the type of taxes you could experience. Now, the first one is income tax. Income tax is the amount of tax that you pay on any income you receive. So when you get a salary and they deduct payee, in theory, you're paying income tax. If you're getting rental income and you're paying tax on that, you're paying income tax. This is income tax, and it's the most common tax, and it's the one that you're probably the most used to. Now, the second tax type is capital gains tax. Now, this is still a form of income tax, but it has its own rules. And what is capital gains tax? Well, simply put, it's the value of the property today less the base cost of the property then, and you deduct the two, and that difference in the middle will be your capital gain. Now, this is oversimplification, right? Capital gain is quite complex, and there are a number of different things to look at and different calculations and different allowable expenditure. So I'm going to try keep it as simple as possible. If you have a property portfolio, for instance, your base cost, so that's the lower cost, normally includes, for example, the cost of acquisition and the costs of improvement, right? Cost of acquisition, what could those include? Your purchase price, right? You pay the transferring attorney money to transfer the property into your name. Those are costs of acquisition, right? Maybe you went to an auction and you paid a commission to the auctioneer. That's a cost of acquisition. So you keep these invoices so that your base cost is the accumulation of what you paid for the property plus some allowable expenditure. What other allowable expenditure exists? Cost of improvement. Genuine improvements, not maintenance, not repairs, improvements. So if you buy a piece of land and you start developing and putting buildings on it, that's an improvement. Those type of costs also get taken into account when calculating base cost. So remember, the higher the base cost, the better for you, because the base cost gets deducted from the market value. And the difference between the market value and the base cost is normally what the capital gains is. Now, the capital gains gets calculated and a certain tax gets levied on the capital gains. So obviously, the bigger the gain, good for you. You made a lot of money over the years in capital growth, but unfortunately, the higher the tax that you might need to pay. Then one looks at estate duty. Now, estate duty is a big one when it comes to estate planning. Why? Well, you know what? Some people call it a certain type of wealth tax because anything above 3.5 million rand, you get taxed on. And it's not a small tax. It's 25%. So if your estate, your net asset value is over 3.5 million rand, you know what? You might land up having to pay 20% of that extra amount over to SARS. And that can sometimes be a very, very big one, right? Another tax, and I'm not going to go into detail, but transfer duty. What is transfer duty? If you have a residential property and you're transferring the residential property, so the movement of a property, you are going to pay transfer duty. There's certain tables that apply for transfer duty, and obviously there's a threshold, but typically if you're moving properties around, you'd find yourself paying transfer duty on those transactions. So those are the different tax types. Now we're going to see when they apply and how they apply within the context of short-term versus long-term, right? And we're going to start trying to apply these. So I start out with long-term. Why? Because I do feel that long-term planning beats short-term planning. Yes, there are a whole bunch of benefits planning for short-term gains. The problem is that long-term, if you're going to lose all those gains, what's the point? So plan properly for long-term. Now, long-term, with the tax type that I referred to previously was estate duty. But now remember, all tax types will apply when you pass away, right? So if your properties have a capital gain, guess what? You're going to pay tax on the capital gain. If you're moving certain properties out of your estate, you might actually also have to pay transfer duty under certain circumstances, right? So please keep in mind that there is a cost associated with long-term tax planning, and all these tax types equally apply to your estate when you pass away, right? The only one example that ordinary does not apply would be your transfer duty, because you're transferring out of your estate, and if you're transferring to heirs, you wouldn't be paying transfer duty on that. But your estate duty, taxable, capital gains, taxable. So please keep that in mind, right? Now, how does the long-term estate planning actually work when it comes to things like estate duty? So we did a calculation recently where we took a 10 million rand estate, and we did the maths over what the estate duty could be. We did the maths over what the capital gains could be in this real life estate. We took executors' fees. We took a whole bunch of costs. And at the bottom, we calculated and figured out that this estate was paying somewhere around 33%, so 3.3 million rand out of the estate in costs, right? Now that's big. Now if you have an estate that's worth 10 million and you aspire to have an estate that's going to be worth 10 million rand, can you imagine when you pass away, giving away 3.3 million rand of that estate for nothing? For no reason whatsoever, simply because you did not plan properly. And this is a real life figure. Not kidding around with this. I mean, think about the maths. On estate duty alone, anything above 3.5 million rand is taxed at 20%. So think about it. You're already halfway, almost halfway to that 3.3 million rand. So this calculation is very, very easy to get to, and there's plenty of examples of this available. So to avoid something like this from happening, one has to ask themselves, well, what are the common factors? Why did this happen to begin with, right? I'm passing away and I'm paying estate duty. Well, there's your answer. Estate duty is levied against you in your personal name, right? There is no estate duty for companies. Companies don't pass away. There's no estate duty for trusts. Trusts don't pass away. It's you and only you. So what does that mean? If this property was not in your personal name, maybe you wouldn't have to pay all these costs. All right. Now let's take it one step further. Great. Can I put it into a company? No. See, that's the thing. You own the company. So if you have a 10 million rand property in a company, or you have a 10 million rand property in your own personal name, guess what? Either way, you're holding either 10 million rand of shares or an actual 10 million rand property. So it's not really going to help having it in a company. What could potentially help is utilizing a trust, right? And no one's saying put it directly into the trust, but at least utilizing the trust to either hold the property or hold the shares in the property. Why? Well, a trust is not you. It's an individual person. A trust runs by certain set rules, and even if you're a trustee of the trust, it has its own rules, right? And it is there for the benefit of the beneficiaries. It is not your piggy bank. It is not your alter ego. And you can draw benefits from it, and so can your other beneficiaries, but it's out of your estate, meaning when you pass away, the property is no longer with you. It sits in the trust of the company under the trust. So that's some long-term considerations for you to think about. What are short-term considerations? Well, it's quite simple. Think about you having a property in your own personal name. Now you're young, you buy your first property, and you're sitting at the lowest tax bracket. So you're paying around the 20% mark as an example of tax, right? 18, 20%, very, very low tax rate, right? What happens? What happens when you start earning a bigger salary? You get those promotions and you get a nice position, and now you're still paying, and now you're still getting this rent, but now your salary is pushing up those tax brackets, and slowly you start going up and you start going up, and now you're sitting at 45%. Now, unfortunately, your property portfolio is still going to be taxed at 45% because your salary just pushed you up these tax brackets. So is it a good idea having it in your personal name, especially if you're aspiring to get good jobs or you're aspiring to build a large property portfolio? No, not really, because one day, at some point in time, you're going to shoot up those tax brackets. So what other options are there? Well, you could use a company as an example. A company gets taxed at 27%. Yes, you know what? There are certain downsides where if you want to draw dividends, you have to pay tax on those dividends, but there are ways of legitimately drawing money out of the company. So 27% already starts making sense, especially if your investment strategy is to compound and reinvest. So I want to take the earnings from the rent. I don't want to use them. I want to keep reinvesting them and building up my property portfolio. Company is a really nice way of doing that because the money stays in the company and the company utilizes it to build up its asset base, right? Another option is maybe put it directly in the trust. There's great short-term benefits to that if your beneficiaries in the trust have reasonably low tax rates or no tax rates, below the tax rates, right? Why? Because our law recognizes that income that flows into a trust, yes, gets taxed at 45%. It's everyone's panic. But if it doesn't stop at the trust and the trust doesn't retain that income and flows it through into the hands of the beneficiaries, it doesn't pay the 45%. The beneficiaries are then responsible to pay tax in their own names. Elderly parents often have very low tax rates. So guess what? Tax rates are going to be quite low. Children, if you're providing for the children above and beyond maintenance, those tax rates are going to be incredibly low. So you might want to consider, if you're spending this money anyway, and you're doing it for the benefit of your beneficiaries, why not utilize a trust to get the money to them, as opposed to earning it, paying your 45% and paying it through to them? Think about it. A beneficiary with no tax rate can pay zero tax. You, at your upper tax rate, are earning, so every 10,000 Rand you receive, you might be paying 4,500 Rand out of it away, leaving you only 5,500 Rand. That's half, almost half the amount that the beneficiaries would get if the money flowed through a trust. So think about it. Different options, different opportunities. If you want the short-term benefit for your beneficiaries because you want to use the money, consider using a trust. If you want long-term gain of building up capital assets, maybe use a company to retain the earnings. This is not to say that these two can't work together, because more often than not, I find that the trust holds the shares in the company, so it's good long-term benefits, But the short-term benefits lie in the fact that the company is retaining the earnings, or the trust is passing the earnings on to its beneficiaries. So it's just a couple of options to think about. Now, why this is very important for you to think about it today is the fact that to try and move properties around later is a fortune. That's where the transfer duty tax type comes in. When you're moving around residential properties, you're paying transfer duty, you're paying conveyances. If you're moving around shares in companies that own residential properties, you're paying transfer duty. So to try and move this around later comes at a cost. If you're planning to have your estate built in a certain way and you're confident that you can build it in that way, look for advice. Do the maths. Do the calculation of how much a trust would cost versus how much tax you'd potentially pay when you pass away. And if the cost is less than the tax that you're going to pay, seriously consider using a trust structure in order to administer your affairs and properly plan out your estate.